this episode of the Living and Working Abroad show, we're repeating a common theme. It's the end of the tax year. It's the start of the year, but it's the end of the tax year. So let's have a look at what we need to do in 2026 to save tax and to avoid confusion, delay, penalties, and charges. If you're an expat living in the UK, or you're an expat living outside the UK and you've got pension, property rental, or capital gains in the UK, you're likely to have a tax return liability open to you. We can fix that, we can help you with that by looking at how and getting the returns done. Now, let's go through what this end of the tax year means to the 31st of January 2026. It's the end of submissions in the UK for the 24-25 year, but it's also the last chance to amend a tax return for 23-24. So you could be, we're talking about looking at tax from 23, 24, 25, and this is your last chance to get the right return. And if it's going to take the Inland Revenue a year to do an assessment and pay another year to pay a rebate, then do you really want to be caught up in that? The HMRC are a good organisation, but customer service doesn't help. We cannot spend time for you, spending hours and hours trying to speak to HMRC. It's unproductive time. They're swamped and overrun. The best thing to do is to submit the return and submit it on time. So let's have a look at what we need to do. In the middle of January 2026, half of the tax returns that need to be done in the UK, half of the 12 million tax returns that need to be done in the UK by the end of January have not been submitted yet. You must put that tax return in if you're asked to, or if you've got tax to pay. So for expats in the UK or outside the UK, what that means is either you've got property rental income, or you've got employment in the UK, or you've got some sort of pension income or other taxed at source income that we need to get fixed. Okay, so let's have those returns need to be in. If we don't get the returns in on time, you've got penalties. If you do get it in on time, but at the last minute, you've got another year to wait before you get your assessment and your tax back. So let's plan ahead. Let's get it done properly. The UK tax year is to the spring, based around the spring equinox, the Easter period, 25th of March. It's actually the 5th of April. There's a history to that. Watch our show elsewhere to find out the reasons for that. Other countries have a calendar tax year end, and HMRC report and provide information so you can do your tax returns based upon a 31st of December or an end of March tax year. Well, the UK has an option. It's not compulsory to do a tax return. In other countries, if you live in Cyprus, Portugal, Spain, France, Ireland, Netherlands, and you're an expat or a tax resident, then you've got an obligation to fill out a tax return. In Cyprus, in 2026, it's compulsory for everybody in Cyprus over age of 25. So once you finish university, college, national service, you've got to fill out that tax return every year. So that's now compulsory for everybody. So if you're a Cyprus expat and you haven't done a tax return in the past, you need to update your tax registration connected to your property ownership and your overseas income in Cyprus to get that working for you properly. For more information and guidance, contact Proact Partnership with the Cyprus office or EU office for more information and guidance. Cyprus, every tax resident must do a tax return. Watch our previous living and working abroad shows to find out how much taxes have dropped and personal allowances have gone up in Cyprus this year, making it a more attractive location for expats, but not for the UK. In the UK, personal allowances are frozen, uh, the taxes have gone up, and so there's lots of issues for people. Even an expat leaving the UK still got those obligations back in the UK. Let's have a look at the things that we need to be aware of when finalising or amending your tax return that's due now. Okay, so the 31st of December, 31st of January 2026 is the date that you must have uh, filed your first tax return online for 24-25 in the UK, or you'll find the 31st of January 2026 is the final deadline which you can amend your 23-24 submission. No paper returns at this stage for those returns. It's got to be done online. So as tax saving experts for expats, we can help you with online returns and with getting the returns done quickly and online before the end of the tax year. We've got the ability to submit a return online now. If you've got a tax number in the UK, even without doing any registration or updates, we can get that all done in the tax return. And then once it's in, we can then amend it in the following year. So let's have a look at what we need to be aware of. Capital gains tax. If you've sold property in the UK or other capital assets, then capital gains tax is a liability. Now, the rules are a bit vague and the rules are changing. It's ever moving feast. But if you own a principal private residence in the UK, it's still capital gains tax free. Okay, but if you sell the property, you still have to do the capital gains tax return to claim that. And one of the ways that this current government are working is to use the local authorities to collecting taxes on properties for owners. But in the Halloween budget of October 24, the other thing that happened was that capital gains tax rose quite a lot. So for 24-25, if you've got a capital gains tax calculation, it becomes very, very, very complicated. The basic capital gains tax rate went from 10 to 18%, and the higher rate went up from 20 to 24. No change in the personal allowance, of course, but those changes to capital gains tax were in effect from the Halloween budget in October 24. So if you go at capital gains in that year, or you've got investments that are being realised during the year, your capital gains tax rate is going to vary depending upon when the gain arose and when the chargeable event is. We can help you with that, and we can get the right returns in and get the right calculations in. HMRC are the people that do the assessment, but the HMRC have actually admitted that they cannot guarantee under the old self-assessment system that the capital gains tax calculation for 24-25 will be correct. They recommend that you work it out yourself. So HMRC assess it. If you've got a professional calculation of what your rate is, despite the fact that the government complicated it by changing the rates during the year, HMRC can't deal with that. ProAct can. We can help you get that capital gains tax return calculated and submitted, and get it right, and then it's a fair. If we as tax agents submit our professional calculation, HMRC are likely to accept that. There might be some aberrations, but again, we would deal with that as part of the tax service that we're dealing with. So capital gains tax rates have gone up by up to 80%. HMRC don't know how to calculate it properly for 24-25. ProAct do, and we can submit the return in. even if you've submitted a return already and you need to make an amendment, we can help you with that as well. Because we've got for the 24-25, once it's submitted, we've got another year to do an amendment. So we could be coming back to it later on for you. Next, you need to decide how you're going to organise your income and declare your income. As an expat, you could be owning property through a company and pay corporation tax rates, which for lower property rental portfolios could be lower than income portfolios. And again, you get the advantage that if you own property through a company, then the capital gains tax rate is based on the corporation tax rate, which is now a little more or about the same as the capital gains tax rates you're going to pay anyway. So it can be a more cost-effective way, with a side issue of stamp duty, making moving that property around not necessarily the best thing. You could be you could use a company, or you could just be self-employed. So if you're an expat working in the UK, or you're an expat working remotely to the UK, you could be working as a contractor. So British nationals don't automatically have a right to live and work abroad in the EU, post-EU legislation. However, if you've got a right of residence because you've got accommodation, you can live and work abroad in Cyprus or the EU, and do a contracted work from the UK, either as an employee, or as a self-employed contractor. And because your income's arising from the UK, you report it in the UK. But because you're non-resident, the tax liability can still pass to that other country. So you can't take employment in the EU, but it doesn't mean that you can't digitally remotely work as a nomad in the EU, whether that's Cyprus, Portugal, Spain, France, Netherlands, anywhere in the UK that you want to work. For more information and guidance on living and working abroad as a tax resident without while doing work in the UK, contact us at ProactPartnership.com. There's big changes over the last few years in national insurance contributions. One thing that's not changed recently is that if you're a British citizen and you go to live and work abroad, you don't have any entitlement to any state benefits. However, there are reciprocal social insurance agreements between different countries, and if you've got a social insurance record, national insurance record in the UK, you can still get um, um, you can still get, using the social insurance agreements between the two countries. There's a double taxation treaty for income tax. There's a social insurance agreement for national insurance, and that gives you access to go to an EU country, for example, or other countries like Turkey, and get medical cover and some very, very basic benefits from the UK. It's not perfect, but that national insurance contribution does one big thing for an expat, whether you're in the UK or abroad. It allows you to maintain a contribution and credits towards a UK state pension. So if you're a British citizen, or if you lived and worked in the UK for more than 10 years, maintaining national insurance contributions for up to 35 years can give you a right to that state pension. So you've got to need to make that value judgment. Um, if your taxable profits are over 6,750, 6,725, you don't have an automatic obligation to pay class 2 anymore in the way that you used to do. You used to have to pay class 2 and class 4. Now it's just class 4. But you can still, you can pay that if you wish, at least to maintain as an expat your state pension benefits. Um, so if you've retired early, but you haven't got a full contribution towards your UK state pension, you might want to consider national insurance contribution. you can put that in a tax return, or you can do it as a separate piece of work, and ProAct can help you with that if you contact us at proactpartnership.com. Payments on account are a nightmare, and the system going forward should change, but not that much. So, if you've got a tax return in for 23-24 and it has been assessed already, they will automatically ask you for the same amount of tax for the next year. So whatever you put in your tax return for 24-25, they're going to ask you for that payment on account next year. And again, that can be a big issue for an expat. Now, if you're living and working in the UK as a self-employed contractor or an overseas contractor with property rental or self-assessment obligations for property rental or investments, then yes, you will make a payment on account, and you may need that to be adjusted, and ProAct can help you with that. But if you don't need it adjusted, if you don't need to pay it at all because you're an expat and you've got no additional liabilities, then we can apply to get that reduced. But you need to take that proaction, because if you don't, whatever your tax liability is for this year will automatically be your self-assessment payment on account for next year. And it quickly ratchets up. They add 3,000 and 3,000, and before you know it, you look like you've got a big hefty tax bill, and it you're paying that in advance. But look out for the interest charges that you might be implied there. So better to get the return in, and use a professional agent. And if you're being asked for too much payment on account, to get that adjusted. Be aware that whatever your tax liability is for this year or for last year, so if you have a tax liability in the UK for 23-24 and you left the UK, now got no tax liability in the UK, they still ask you for the same self-assessment. So we need to get the returns in and the registrations in to reduce your self-assessment and payments on account liability. Whatever you submit on your return for this year, for 24-25, by the end of January 26, that's what they're going to self-assess for next year. So if you've over committed yourself, you need to amend your 24-25 tax return. We can still do that right through for another year. But if you do expect that payment on account to come your way, unless you take no action. For more help and guidance, contact us at proactpartnership.com. HMRC will always, when they send you a statement, will always take account of any payments that you made. So what have you paid? And if they make an assessment, you pay that tax already, they will ask you to pay more. So if when we're doing your return to January the 31st, 26, for the previous tax year in 25, if you've already paid too much tax, you've already made a payment on account, we can use that payment on account to offset against the tax you paid here. So don't overpay them too much now, because it's not necessarily to your benefit. If you've got a tax liability from assessment or from payment on account, and it's overdue, they will charge you interest, and they will charge you interest at 7.75%. But if you're in credit, they'll only pay you interest of 2.75%. So you're going to get charged 5% more for paying too little tax as you'll be doing for paying too much. So you do get a credit if you've overpaid tax, 2.75, and it's better to pay too much than too little. But it's not balanced in the way that it used to be. The interest paid used to be the same as the interest charged, and therefore it always balanced off. If you don't agree with the assessment and you believe that you can prove that you don't have the tax to pay, even if there's a tax liability there, you can still, although they'll charge you interest, when they credit you back to wipe off the tax that you're not paid, they will credit you back the interest as well. So it's a value judgment, it's a professional judgment. We can give you that help, advice, and the guidance in a free review call, or we can submit the returns for you. Contact us at proactpartnership.com. The last thing to forget, um, the last thing to remember, not forget, is crypto. Lots of people have got investment portfolios which include crypto now, and many people have just got a crypto portfolio. Crypto is a capital asset. So as you're buying and selling crypto, that's a capital gain, and that's reportable. The capital gains on crypto have fallen massively over the last 20 years with the current the last two governments. So now you've got very, very little capital gains allowance for property, shares, and crypto sales. And then the capital gains is going to be charged at anywhere between 18 and 24%. So there may be some longer term tax planning that you can do to protect your crypto assets from that gain, especially if you're an expat living and working abroad. But in your tax return, if you've got a crypto portfolio and you're buying and selling crypto during the year, it needs to be reported as a capital gain, not as income, not as an investment fund just left there for nothing. So there are types of investments where you can hold money without having to tax report it. But crypto, buying and selling, you have to report. HMRC try the best, but they have got a service issue. They can't take your calls all the time. They can't deal with your inquiry. You can spend a lot of time trying to speak to people and not getting through. HMRC are the people that assess your tax return and decide how much you've got to pay. You can report and make your claims to pay the right amount of tax, and for that, PROACT can help you do that. Even so, if you've overpaid tax, it can take more than a year to get that tax saving back off HMRC because they're not making an assessment. 23-24 returns for the UK can still be amended up until January 26th. So then they're going to really pile on the assessments and get that through. So get your returns in early and get them right. And you can contact us at proactpartnership.com. We can give you the advice and we can get the returns submitted. By the end of January 2026, you need to submit your 23-24 return in the UK. If you've not done that yet, we can still help you, but you need to contact us now that we can do that. If you think you need to amend your 23-24 return, this month in January 26th is the last time you can do that. So if you want to make a gift to reduce the amount of tax liability you had in 23-24, or make a charity payment to reduce the liability, or if you've omitted some information and you need to update that previous tax return, or even if you've just submitted previously an estimated tax return and it's not the correct figures, we can get that amended, but you've got to amend your 23-24 return by the 31st of January 2026. And PROACT can do that. We can get that all done for you in the next couple of weeks. If you need that help and guidance, you can contact us at proactpartnership.com. Thanks a lot for listening. It's the start of a new tax year. We're starting 26. If you want to plan ahead and do your 25-26 tax returns, we're ready to take your instructions now, and we're also already submitting those returns. Both for calendar tax year end countries like Cyprus, Spain, Portugal, France, Ireland, Netherlands, but also for the new UK tax year to April 26. We can start to gather the information now and start prepared to get the return in early, so we get an early assessment of 26, and you get your tax savings and tax rebates and tax affairs brought up to date quickly. You may be in a country where you don't need to do a tax return, like the Middle East, but if you're an expat with UK property rental, capital assets and investments, you may still need to do a tax return for capital gains, property rental income, or if you're working as a digital nomad or remote working from a UK contract or a UK company, again, that UK tax report becomes necessary. Contact us at proactpartnership.com. Thanks a lot for listening, and we'll see you next time.